Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Matt, the mortgage guy. And we are going to talk the housing market, real estate, interest rates, and my favorite, the metric that saved my ass in '06, the affordability index. How you doing, buddy?
I'm doing great, Mike. How you doing?
I'm doing well. So you've read my story, one rental at a time. You know, I was deep into housing. I was looking for my ninth house and it didn't make financial sense. I went and heard a gentleman speak named Bruce Norris. He told me about the affordability index. I researched it, and in my market, the affordability index had crashed. And lo and behold, I follow smart people. So I sold every house and 1031 into apartment buildings. Why do I bring this up? Because the affordability index, again, nationally speaking, please, everybody go do your own research. I have a national show, so we're talking nationally here, just got to a new low, which is not good. Affordability, because we saw a rate rise of a full 100 basis points or 1 point in about a 60-day window, on top of a other point raise in about a 3-month window. Housing's unaffordable. And I think the Federal Reserve broke housing. So what we have to talk about is, because we are at the extreme of housing affordability, what happens? I only see two options. Maybe I guess there's three options as I talk about it. But as we get here, what do you think? Ask me any questions you want, because I only see three options from here.
Yeah, I mean, I totally think that you know, we're yet to see this big pull down in demand, right? But it's coming. It's coming. You know, somebody like me on the front lines doing mortgage is seeing and hearing, you know, unfortunately, the ones that are at the very bottom, first time home buyers, whatnot, like they're unable. And so like there's going to be a drawback in demand from two groups: unable, you know, just don't qualify anymore, and then unwilling, right? There's some people that I talk to that were going to move up and they were going to go from a $650,000 house to $1 million house. They're well off, but they look at the numbers and they go, you know what? Like, I don't want to add $1,500 to my mortgage payment. It's not that important to me to go from this neighborhood to that, or from 2,000 square feet to 2,800 square feet. No thanks, right? And so, you know, I hate to use dramatic terms, but like falling off a cliff from a demand perspective, you could see a 30 or 40% decline in demand, which I think it's good to remind people does not mean housing correction, 40% decrease in housing prices, because we're so imbalanced to start, right? This teeter-totter is like this right now, supply and demand. So if we see demand pull back a lot, we're more balanced. And I know you, Mike, have your theories on, you know, supply destruction, which might pull that side down too. And so the teeter-totter remains imbalanced.
Yeah, we're going to talk about all of that in this show, because it's really important for people to realize, because I use the word crash. I put crash in the title. I'll probably put crash in the title of this one, but it's transactions crashing, not price, because there's only really one of three things that can happen where we are today. And again, we are on the very front lines. It has changed in the last 2 weeks. The stuff that's closing today was in contract 45 days ago, not relevant. We need to still look out 60 days. So again, it's the middle of April. Let's wait till the middle of June. I promise you transactions are going to fall. The question is, what's next? One, demand is without question. That's what the Federal Reserve is trying to do. The Federal Reserve raises rates. They will be selling their $9 trillion balance sheet to raise rates. They are purposely calling for demand destruction. That is a tool. How do you break inflation? You crush demand. That's just how it happens, right? So demand destruction makes sense. Tighter credit makes sense. We're adding fees to investment loan makes sense. Demand is going to be destroyed, at least in the short term being a couple of years. Next, we do have the supply side, which again, I think the Federal Reserve broke. If they did not keep rates low for so long, it would not be a non-issue. But you talked about it, the $600 to $1 million house. I talked to agents across the country, and all of them are telling me they have people that are just not going to move. They're just done. I'm not going to give up. The 30-year mortgage, sub 4%, let alone sub 3%, is a financial asset. It's an asset. It is an asset. When was the last time somebody in the U.S. could borrow money for 30 years sub 3, which, oh, by the way, is a negative rate. It's a negative rate. You are borrowing money at a negative rate. Why the hell would you give that up?
Yeah.
You wouldn't, right? So, okay. So let's play this out because I want to talk about supply and demand. Let's go back to like 2018, and we got to do some numbers together so we can scale this together. 2018, generally speaking, was as close to a balanced market that we've seen in 5 years. So we're going to use 100 as a factor. So the supply was 100 and demand was 100. Okay. Let's fast forward to 2021. Supply was 80. Demand was 500. Right? With me so far?
Yep.
Right. So 580. Now, as of today, middle of April, supply, I'm guessing, or let's actually talk not April, let's talk June, right? When I have supply destruction. We're going to go from 80 to 50. Our demand, which was 500, is going to go to 100. Guess what we just did? We still have demand at 100 and supply at 50. We are still out of whack. Now, as an agent, that means you're not going to get 15 offers. This means you're going to get 2 or 3. It's still going to be unbalanced. I believe what we're going to have is a flat real estate market. I believe real estate will go up with whatever the inflation rate is. In fact, I believe maybe this year or next year, housing goes up slightly less than inflation. So on a nominal basis, housing goes up, but on a real basis, housing goes down slightly. What do you think of that?
Yeah, I think if I were to bet on next year, 2023, 2 or 3%, I personally think that like, even if I think it'll take a little bit of time for the flattening to occur, where it's like the first quarter was so bananas that might have been a 5%, right? Oh, yeah. So even if we were flat the rest of the year, we might see a 5, flat-ish. We might see it be 10% or 12% just because of the lingering effects, and I think too, like me and you have talked about, the consumer reacts and real estate reacts slowly to where as this inventory comes on over these next few months, just natural seasonality of real estate, more listings in the summertime. Like I think those continue to get gobbled up. And there's like, as demand's falling, there's some like spillover effect or whatever the heck you want to call it. Just like people jumped off the fence to get mortgages and refinances before rates ticked up. But I agree with what you're saying too. And I think that like the supply, all like the seasonality of more supply coming on, and maybe some other factors that are causing people to sell where we would normally see up in supply, that supply destruction that you talk about keeps a lid on it. Maybe not 80 to 50, maybe just 80 to 60, or even maybe 80 stays the same. Yeah. But to your point, when we go from 500 versus 80, we're basically like 6 to 1 ish. And then we come back down to 100 over 50 or 100, then we're 2 to 1 ish. Like that's a more balanced market, right? That's a market where like you can look at just those 2 factors. And for the average person, like look at a couple things, right? Look at the affordability index, look at supply versus demand, and you should be able to tell like more this than that, home prices will go up. They'll go up at a lot slower pace. And, a flat market for my day-to-day job would be amazing for the conversations I have and for the, the outlook and the, sanity of buyers and real estate agents that I'm working with day in and day out. Flat market would be amazing.
Yeah. There's 15% appreciation at Case-Shiller, or 19 or whatever the last, it's got to stop. I think rent increases got to stop. I think there's something bananas going on in the rental market. And I say that as a landlord. I think this price shock is bananas. I think it's over. I think we could have a flat 5 years. And when I mean by flat, it means right even with whatever CPI or inflation is. It could be up 1 or 2% up or down from inflation. We're not going to have another 20% appreciation. It can't happen. It's unhealthy. It's unaffordable. That's demand destruction is happening. I think a recession is in the future. JP Morgan today actually had a $900 million, almost $1 billion loan loss reserve created. So they expect a recession worldwide, not only North America. So we get a lot of big banks reporting tomorrow. So I think they're nervous. I think they're also going to talk about loan. I think rates went up so fast that banks are not going to make as much money, because normally speaking, rates go up as banks print money, but rates went up so fast. I think they're going to have loan destructions and actually may have some layoffs. What do you think?
Yeah, I mean, we've seen mass layoffs, in mortgage banking, right? And so I wouldn't be surprised. A lot of mergers and acquisitions, a lot of layoffs, a lot of
Trading is down.
consolidation, and it'll be interesting to see too, because I think people always wanted to ask, or we're always asking, you or me or anybody, like, what's the inflection point? What's the inflection point on prices going up and interest rates going up where it's going to affect the consumer? I think that we've hit the inflection point.
Agreed.
It just hasn't settled.
You need the delay, right? You hit it, but in real estate, you have a 60 or 90-day delay, because you have people that are closing now that have the rate locks and.
Right. Yeah. The stuff that's closing today and all the data that you're getting next week was buyers from January, February. Yeah. Right. And so you're exactly right. Like, once this stuff comes out in June, people are going to look back and go, oh, wow. Yeah, I guess demand was down. I guess rates did have an impact. I guess
that hurt.
Right. Yeah. And really it's as much of a function as, rate increase and home price increase. It's a much of a function as the speed of it, I think, than anything else. Like, because people are getting shell shocked. Yeah, right. No. When they revisit something that 2 months ago was this price and this rate, and now we're this price and this rate, and that's a difference of $450. For some, it's no longer in the game, and for others, it's like, maybe on the fence decision, like, do I still, buy?
Yeah, I got you. Well, do me a favor. How can people find you? Because again, deals are still going to be done. Investors are still going to buy. Homeowners are going to buy. And I strongly recommend they reach out to you for the best service. And if they're doing a refi today, they must reach out, because a lot of them have been pushed bad product. How do you want them to reach out?
Right. Yeah. And if you're still in the market to buy, there's still a ton of folks that it makes sense for them to buy. They qualify, and, there's still going to be 2.6 trillion in mortgages in 2022. We're more than happy to do it. We happen to think that we've got, best in class service over at UMortgage. So go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help. Educate yourself as a buyer. Make sure you have all the information up front. Make sure you're fully pre-approved and you understand your options. That's the best way to get in the game versus going out and seeing a pretty house and saying, oh, I'd love to offer on this, right? do the financial stuff first.
Absolutely. Thanks, buddy. I appreciate you.
Thanks, Mike. Mm-hmm.